Welcome. Good to have you with us. This week, I'm going to begin with a segment we haven't done in quite a while. That is the Reverse Mortgage News Roundup. I'm going to give you 4 stories as succinctly and as quickly as I can. So here we go to the first, and it's relating to Finance of America's expansion of one of their proprietary products. Housing Wire reports that Finance of America, or FOA, has expanded their HomeSafe Second reverse mortgage, now being offered and being approved in 3 more states. Recently, they added Indiana, Ohio, and Michigan, which brings their total number of approved states up to 16. So the product is now available to the residents in those states, and it's targeting homeowners who are 55 and older who want to tap equity without refinancing their existing first-rate mortgage. And as we know, during the pandemic and after, we had insanely low mortgage rates, which many are still holding today, even as low as 3.25%. Can you believe that? Those days are behind us. So this product does fill a particular niche. According to their press release, Finance of America notes that move comes as many older homeowners are finding themselves equity rich and rate locked. And usually we say equity rich, but cash poor. So this is a different type of client. It's a different type of market because these individuals obviously can continue to make their payments on their first lien position mortgage, which is at a very low interest rate. Kristen Seifert, president of Finance of America, said in a statement, many retirees are facing mounting pressure from rising healthcare expenses and everyday living costs while navigating unpredictable markets. And the next story is the brutal truth why the HECM for purchase just has not really grown to its full potential. And for that, we go to another column in Housing Wire, who interviewed industry veteran Michael Banner. The loan that was once hailed as a potential game changer for retirement has largely failed to gain traction in the market, not because of its design, but due to shortcomings within our industry itself. That's according to Michael Banner, National Reverse Mortgage Educator and leader for American Pacific Mortgage. And by the way, Michael was our guest speaker last week here at HECMWorld on that very topic, entitled Why Realtors Are Ignoring Purchase Reverse Mortgages and How You Can Change That. And Mike shared his unabashed opinion, which I asked him to, because opinions at least elicit some sort of, scrutiny and rethinking our approach. And so if you'd like to see a replay of that webinar, just go to HECMWorld.com and you can view it there. Banner notes that financial planners and long-term care specialists still don't like reverse mortgages, and 90% of the world still thinks that we take the house, which we don't. Our industry is our own worst enemy. Adding that when the HECM for purchase was first launched in 2009, Nobel Prize winners in economics said that it would literally change the way that America retires. But sadly, that has not been the case. And in his opinion, the math shows that it represents less than 3% of overall reverse mortgages across the world. So in his premise is that the product hasn't failed, but we have failed to properly introduce the product to the public. You have to show them why it is to their advantage to do that. In other words, what's in it for me? That's the question that a realtor is going to be asking any real estate professional when you approach them with a HECM for purchase, and you have to be able to clearly articulate that. And last week, the news broke that High-Tech Lending, a top 10 HECM lender, has secured a very important distribution channel in its partnership with Better. They had partnered with Better to expand access to home equity lines of credit through their Equity Select HELOC loan, and that will be through Better's retail channel, NEO Home Loans. Housing Wire notes that Equity Select is tailored for credit-worthy homeowners of all ages who simply just don't fit traditional underwriting guidelines. In fact, there are many individuals that are being declined for a traditional HELOC today, especially amongst the older cohort. Today, it's estimated that U.S. homeowners hold an estimated $35 trillion in home equity, according to High-Tech Lending, while around the same time, 26 million borrowers are locked into mortgage rates below 4% on their first or primary lien. Those with incomes that vary month to month and the self-employed often struggle to qualify under traditional underwriting guidelines. Life changes, incomes fluctuate, and financial needs evolve, said David Peskin, president and CEO of High-Tech Lending. Homeowners deserve options that reflect those realities. And through our partnership with NEO Homes, powered by Better, we are expanding access to responsible home equity solutions for borrowers who have been declined under traditional guidelines but are otherwise strong, credit-worthy homeowners. Perhaps you've heard of Better.com or seen one of their ads or visited their website. They are an online AI powered lender, and they are able to actually turn around applications very quickly, oftentimes within 1 day. And so this partnership really broadens the distribution channel for a unique product that can help those that have been turned down for a HELOC. Most importantly, under the agreement, Housing Wire says that NEO Homes will offer Equity Select HELOC as part of their product lineup, while High Tech Lending will purchase loans originated through the program. And in our last story, there is a big shift on the corporate side of reverse mortgage lending. Perhaps you've heard the news. Liberty Reverse has exited reverse mortgage originations, but their parent company is also making some changes. Onity Group announced that their mortgage subsidiary, PHH Mortgage Corporation, has rebranded as Onity Mortgage, and that move was anticipated and became effective last Monday. Glenn Messina, Chair, President, and CEO of Onity Group, said in a statement, "Today marks another important milestone in our multi-year transformation as PHH Mortgage officially becomes Onity Group. These changes bring our flagship mortgage platform under the Onity brand and reflects who we are today, a top-tier, technology-enabled mortgage lender with diversified business, strong growth momentum, and a relentless focus on creating value for our customers," said the statement. This represents a fresh face and a fresh branding for PHH, now being Onity Mortgage. We have with us Jon McCue from Reverse Market Insight.
Thanks again for having me back again, Shannon. Really appreciate it. I also appreciate you giving me the opportunity to give a shout out to our latest tool that we have, our reverse qualifier pricing calculator that we have come out with. And if you guys haven't heard about this, it's pretty fantastic. You can always find it at rminsight.net. You can always reach out to me directly from there as well. It's really changing loan officers' lives. I got people that are closing more loans than they would without it. It's pretty phenomenal. I'd love to share more stories with you. I just don't have the time right here, but I just wanted to thank Shannon for giving me the opportunity to shout it out, because I was just telling him how excited I am about this, just because of the stories I'm getting are so fantastic, and the conversations I'm having with these loan officers are pretty phenomenal also. So thanks for letting me do that, Shannon. Back to this month, we're looking at February data. And luckily for us, HUD has gotten back into the swing of things with data. Things seem to be kind of flowing. Unfortunately, when I checked earlier, case numbers are still only up through January, which is fine. I'll take that over where we have been for the last 2025, pretty much. So, again, finally, recent data. The bad news here is that the year is starting off a bit weaker, unfortunately, which, a little surprising, but not so much. And we'll talk about that here in a second. Total case numbers were down 5.9%. New equity was down also 5.9%. HECM for purchase was down nearly 15%. And HECM to HECM was down just over 4%. So, in the next slide, we're going to take a look at the 10-year CMT. And what we'll notice is that in January, the index began to rise. And so with that said, it isn't a surprise to see these numbers drop from December. Plus borrowers are just coming off of, the holidays and things of that nature. So, not really too surprising to see January numbers down. We're not too far off of the 2025 numbers, but, we are where we are. Also in the next slides, we're going to see that these drops in the case numbers are also going to have an effect when we start looking at January endorsement numbers. As far as the 10-year CMT, I like, adding this now just so we can kind of keep track and look at this. And I think it's, kind of important to see where we were at the start of last year, how it's kind of flowed through to this year. So we can see that in February, the 10-year index, started to fall. We also had the government index or government shutdown in October, which, that was one of the contributing factors to the rise as we started to see the index rise in October, kind of peaked there in January before starting to level out. However, with the instability in the world, especially around oil, we're beginning to see things tick up. But even with that being said, if we look at the 10-year CMT, kind of where we're at today, even if it starts, even as it's starting to go up, we're still better off than where we started the year last year. Things are better than they were last year. Now, as far as February endorsements, are concerned, February is always a tough month. It's a short month, so due to, kind of the shorter months, also we don't really know how much proprietary is eating into the HECM endorsements. So we don't know how much is being, for the losses being contributed to that. But we were down nearly 21% to just over 1,800 loans in February. Again, going back to the case numbers in December and January, we did see those start to go down. So it's not surprising, to see kind of a drop off here as far as endorsements were concerned. Again, rates are beginning to drop in February, starting to kind of tick up here in March. So hopefully, this was just more of a short month, more than anything else. But, again, only time will tell. Now, and as you'd expect with any big decline, there wasn't any region, spared from this. New York, New Jersey fell the least, declining only 1% to 100 loans. The Midwest also held up, better, only dropping 3.3% to 174 loans. But all the rest, they fell at a minimum of 11.4, and some well over 30%. As far as the top 10 lenders, all of them were negatively affected in February also. Finance America had the smallest drop, losing 8.5% to finish with 364 loans. Longbridge was down 9% to 304 loans. All the remaining lenders, again, you can see, between nearly 16% to pushing 50% drop. So, so 1 month, we'll see what happens here. But yeah, kind of a very interesting February. Februarys are always interesting. This one seems to be a little bit more so. Now that we're getting more data in regularly from HUD, we're starting to get a kind of a better picture of what's driving volume. We still need just a few more months, I feel, to kind of get caught back up and really kind of see where things were moving and how things have been moving, to kind of get a really good sense of where we're at. But yeah, it's interesting. So let's revisit this in a couple of months as data continues to feed in on a more regular basis. But we are seeing some trends, I think, that we're starting to see. So tune in next month to see what data we get from HUD and what possible impact those numbers will point to.
Last week, I came across an interesting column in Kiplinger, which led me to ask myself, if the face of the equity borrower is changing, are our conversations as reverse mortgage professionals also changing as well? Under HELOC rules are changing in 2026, it notes that lender rules and shifting rates are changing how HELOCs work. They note that HELOCs are not the same as they were just a few years ago. There are new lender rules, evolving rate dynamics, and also tighter borrowing requirements or lender criteria on how these loans work in practice. And understanding those changes is key to determine if a HELOC does fit one's financial strategy. And of course, that has led to the evolution or development of equity-based HELOCs in the reverse mortgage space, not necessarily reverse mortgages in all cases. And there are some flexible options that you're going to find in these loans that you just won't with a traditional HELOC, as we just mentioned in an earlier story. But now there are changes also in the traditional HELOC in the requirements. Kiplinger's column reveals that non-bank lenders, including institutional investors and fintech companies, are introducing stricter terms, with some requiring borrowers to draw a minimum percentage of the credit line up front, which can reduce their flexibility, at least of the borrower, and may not fit with how many homeowners prefer to use a HELOC. It was at least over 20 years ago that I had my first HELOC. I think it was about 25 actually. And I remember I had a checkbook and a zero balance on that HELOC. It just sat there. It was a low fee loan for me to get. And then eventually I did use it in small increments. But today that is changing as borrowers are having to take a significant lump sum distribution up front. That is the changing landscape of the traditional HELOC loan. According to HELN News, some lenders are beginning to require an initial draw of 50% or more of the credit line, with certain products requiring even higher amounts. And by the way, that's very similar to what we're seeing in the HELOC loans being offered within our own industry, or I should say HELOC alternatives. There are a few potential pitfalls for HELOCs in retirement or for those on a fixed income, and one is the variable interest rate, which can change that interest-only payment. Of course, if the rates go up, then that interest-only payment is also going to increase. Then you have the recasting of the loan after the draw period, which is typically 10 years. So after 10 years, then that borrower has to pay the full principal and interest. HELOC rates are variable, which means they can change over time based on broader interest rate movements. And most HELOCs are tied to the prime rate, which is closely influenced by decisions by the Federal Reserve. So what do the financial experts at Kiplinger have to say to homeowners who are considering a HELOC? What should they be looking for when they shop? One is draw flexibility, choosing a HELOC with no minimum initial draw requirement. Now, let me add that for some individuals, that may be actually a good fit, but for others who are needing to do a significant project, such as a remodel, the draw requirement may actually work in their favor because they're going to use those funds anyway. So again, it all depends on the homeowner's need and what solution to match with it. Next is to compare margin and index, not just the teaser rate. Then rate caps and adjustment frequency, and watch the fees closely. So what are the alternatives to a traditional HELOC in today's market? One is a home equity loan, which offers a fixed interest rate and predictable monthly payments. Now, of course, that's going to be a higher payment than you'd find in a HELOC because those are fully amortized. Next is a cash out refinance, and that would only really be suitable for those individuals that are not sitting on a first lien mortgage that is at a historically low interest rate. It allows one to take a portion of their home equity as cash. With rates still relatively high, that option may not make sense right now, but it could become more attractive if borrowing costs or interest rates drop. Another alternative to a traditional HELOC is the 0% APR credit card offers that we often see in our mailbox. Now, those may work for individuals who can actually work with the amount being offered in that 0% offer, but it does require incredible discipline to pay that off before that introductory period expires. Otherwise, you're going to be sitting on a sizable credit card balance and very, very high interest rates, much higher, by the way, than, of course, a HELOC or a cash-out refi. But there is one option that they do not list, and that is the alternative home equity loans that we're seeing in the marketplace that we just discussed earlier in this episode. Loans such as the HELOC for seniors being offered by Longbridge Financial and the Equity Select HELOC from High Tech Lending and American Senior.